Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Hey there, and welcome. Every single day, businesses are betting millions, sometimes billions of dollars on future projects. To make those bets, they use formulas like net present value or NPV. But what happens when the math gives you one answer and the real world seems to be screaming for another? In this explainer, we're going to go way beyond the simple formulas to explore the kind of strategic thinking that turns a good financial decision into a truly great one.
So, this is really the core of our question today. You run the numbers, you get a positive result, and you greenlight the project. Simple, right? Well, not always. I mean, what do you do when the numbers are screaming no, but your gut is telling you this project is absolutely essential for the company's future? Or what if you have two amazing projects, both with positive numbers, but you've only got the budget for one? The formula alone just doesn't give you the full picture. So to really get a handle on this, we're going to follow a decision maker's journey. We'll kick things off with a basic formula, but then we're going to start layering on the real-world complexities, like intangible benefits. From there, we'll figure out how to choose between competing good options, how to deal with risk, and finally, we'll look back to see what we can learn from it all. Think of it like this. Each step is going to add another crucial tool to your decision-making toolkit. Okay, to make this real, let's actually put ourselves in the shoes of the management team at a manufacturing company. We've got a proposal on the table, a huge upgrade to one of our factories. It promises to modernize the equipment, streamline our processes, the whole shebang. The question is simple. Should we do it? This is exactly the kind of high-stakes decision that gets made in boardrooms every single day. Let's start by looking at this factory upgrade through the standard financial lens. We'll calculate its net present value. But as you're about to see, this first pass can be super misleading because it often leaves out some of the most important benefits. The ones that are the hardest to slap a price tag on. Okay, so here's the initial breakdown. The project needs a $500,000 investment right up front. The present value of all the future cash flows is $450,000. Now, that's just a fancy way of saying if we add up all the money we expect this thing to bring in over its entire life, and we adjust for the fact that a dollar today is worth more than a dollar tomorrow, it comes out to $450,000. So we subtract the investment from those cash flows and, boom, a negative NPV of $50,000. Now, if you go by the textbook, this is an open and shut case. Negative NPV, you kill the project. End of story. But wait a second. Let's just pump the brakes here. The spreadsheet is telling us to walk away. But what if this upgrade would also say drastically improve worker safety on the factory floor? Or what if it would boost the quality of our product, leading to happier, more loyal customers? These things don't show up in our simple calculation, but they have real, tangible value, don't they? And this brings us right to this idea of intangible benefits. We're talking about things like safety, quality, and your company's reputation. They are absolutely critical to the long-term health of a business. I mean, think about it. Fewer workplace accidents means lower insurance costs, sure, but also way better morale. Higher product quality means fewer returns and stronger word of mouth. The problem is, because these are so hard to put a precise dollar amount on, they often get ignored in financial models, and that can lead to rejecting projects that would have been incredibly valuable. Okay, so how do we actually deal with these? Well, our source material gives us two really practical ways to tackle this. First up is the is it worth it test. We look at our negative $50,000 NPV, and we ask a simple question. Are the improvements in safety and quality worth at least $50,000 to us over the life of this project? The second method is a bit more direct. We just come up with a rough, conservative dollar value for those benefits and plug it right into our calculation. Now, this is where it gets really interesting. Let's see that second method in action. Let's say that after a lot of discussion, management agrees that, yeah, the improved safety and quality are worth at least $100,000. We add that conservative estimate to our calculation and just look what happens. The whole thing just flips on its head. It now has a positive NPV of $50,000. And this just brilliantly shows how a project that looked like a clear no can suddenly become a very clear yes. Okay, so we've managed to justify the factory upgrade. It's a good project, but reality strikes again. It turns out there's another good project on the table, a new software system. Both have positive NPVs. The catch? They're mutually exclusive, and we only have the budget for one. So, now what? All right, so here's the dilemma, laid out plain and simple. Project A, our factory upgrade, has an NPV of $50,000. Project B, the new software, has a slightly lower NPV of $40,000.
Now, at first glance, you might just say, easy, pick Project A, it's got the higher NPV. But hang on, look at that initial investment. Project A costs more than double what Project B costs. So the real question is, are we getting the best bang for our buck?
And to answer that question, we need to pull a new tool out of our toolbox, the Profitability Index, or PI. As you can see from the formula, it's all about measuring the value you get for every single dollar you invest. You just divide the present value of the cash flows by the initial investment. It's the perfect way to compare projects of different sizes on a totally level playing field.
So for Project A, we take the $550,000 in cash flows, divide by the $500,000 investment, and we get a PI of 1.10. For Project B, we divide $240,000 by $200,000, and we get a PI of 1.20. And bingo, there's our answer. Even though it has a lower absolute MPV, Project B gives us a much better return for its size. For every dollar we put in, it generates $1.20 in value, compared to just $1.10 for Project A. The key takeaway here is Project B is just a much more efficient use of our limited cash.
All right, decision made. We're going with Project B, the new software. But, we can't just pack up and go home yet. All our numbers, our cash flow projections, our cost estimates, they're just that, estimates. The future is always uncertain. What if sales aren't as hot as we think? Or what if the implementation costs go through the roof? We have to account for that risk.
And that, my friends, is where sensitivity analysis comes into play. It's an incredibly powerful technique for dealing with uncertainty. Instead of just relying on one set of projections, we create a whole range of possible outcomes. It's basically a financial stress test for your project, where you ask a bunch of what-if questions. What if our main competitor launches a new product? What if our costs spike? We want to see how sensitive our project's return is to these different changes. So this chart here gives us a great visual of what this looks like for Project B. That middle bar, that's our most likely case, that $40,000 NPV we've been working with. But in a pessimistic scenario, maybe adoption is slow and costs run over, we could actually lose 10 grand. On the flip side, in an optimistic world where everything goes perfectly, the NPV could soar to $90,000. Now, C in this range doesn't give us one simple answer, but it gives decision makers a much clearer, much more honest picture of the kind of risk they're actually taking on. All right, let's hit the fast forward button. We chose Project B, we understood the risks, and we went for it. The project is up and running. So is our job as decision makers done? Not even close. The final, and I'd argue maybe the most important step in disciplined capital budgeting is to look back and learn. This is all about the power of hindsight. We do this through a process called a post-audit, and it's exactly what it sounds like, a formal review after the fact. We just gather up all the actual performance data for the project and compare it side by side with what we thought was going to happen when we first gave it the green light. So why even bother with this? Well, there are 3 huge benefits. First off, when people know you're going to check their work, they tend to make way more honest and reasonable proposals to begin with. It keeps everyone grounded. Second, it's a formal check-in to see if a project is underperforming and maybe needs to be shut down. But the biggest reason by far is that it helps the whole management team get smarter. It creates a kind of organizational memory. And this is what that comparison might actually look like in the real world for our software project. We projected an NPV of $40,000, but the actual came in at $15,000. Now, looking closer, we see revenue was a little lower than we thought, and costs were a bit higher. This isn't about pointing fingers or finding someone to blame. It's about asking why. Why were our cost estimates off? Did we miss something in our revenue forecast? Was a competitor tougher than we expected? And that really just gets to the heart of the matter, doesn't it? This quote sums it up perfectly. The ultimate goal of a post-audit is continuous improvement. By really digging into where we went right and where we went wrong on this project, we can make way better, more accurate, and more profitable decisions down the road. It closes the loop and makes the whole organization smarter. So we kind of end up right back where we started, but now we have a much richer understanding, right? Capital budgeting is both an art and a science. The numbers, the formulas, they give you an essential foundation, but they don't tell the whole story. You need tools to account for intangibles, to compare options, to assess risk. But in the end, you also need judgment. So I'll leave you with this. When the spreadsheet is pointing one way, but your strategic gut is pointing in a completely different direction, which one do you trust? The answer to that question is what separates the good managers from the great ones.